Webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trade. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment security or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides educational and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you can't afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing the webinar, you agree to hold the above harmless from any losses you may incur as a result of information discussed in the media identified above. By accessing the webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. All right, fantastic. Now we're ready to rock and roll. Let me share my desktop, and we'll see what kind of fun stuff is on there, because I don't even know. And I see nothing. Ah, here we go. Wait, something went wrong. Huh. Oh, no, this event is up there. I see, this event is on my desktop. That's what the problem is. All right, hang on. Let's see if we can find something more interesting than that. Wow. All right. Can you guys see my Thinkorswim screen? That's question number one. Can everybody see it? Hello. Oh, thank you. Okay, so let's get going. First of all, it is a it's a end of quarter day today on September 30th. So that's a big day, and that causes a lot of chaos in the market. And one of the things that happens is you have something called window dressing, and that's where a lot of the funds try to jack up the indexes into the end of the quarter so they can print good quarterly gains, and that gets people excited. Because, you know, when they come to you with a brochure and say, hey, you should put more money in the markets, well, they got to show you why, and they want to show you like a nice uptrend for the quarter. Where are we for the quarter, though, is not all that exciting. Let's take a look at stock charts, and we'll look at SPX. It has not been a great quarter, actually. What, are you kidding? No, the plus sign. There we go. Okay, so from June, that's the end of June 30th. So it's from July 1st until now. So we are pretty much dead flat at 1975 on the S&P. That's a dead flat sign for the quarter. They don't want that. They really wanted to close at 2,000 to show some nice progress. Though 1975 is still up from 1850 for the year, so that's up about 125, so a little bit less than 10%. I don't know what that is, like 7% or whatever. So we're up 7% for the year, which is not terrible. And of course, obviously, when you go back, they'll show growth, and look how steady it is. Growth. That's what happens when you're stimulating, right? You get perfect, steady growth. It's like growing, and more growing. So you get these lovely, nice lines. And the reason for that is because the Fed basically, if it's not, the line isn't going the way they want it, they put more money in. And they make the line go the way they want it. They want people investing. They want the investment companies putting money out in the market, so on and so forth. The problem is, though, the money isn't being used for anything productive. The money is being used for stupid stuff like buying back company stocks to decrease the number of shares, Decrease in the number of shares that are outstanding makes the earnings look better because the same earnings divided by less shares gives you a better looking PE ratio. There's a lot of that going on. There's a lot of M&A going on. M&A is the same thing. In fact, M&A increases the PE for the whole S&P in the markets because if you think about it, this is why you see these bullshit charts about the S&P's PE ratio being better. But if you look at the amount of mergers and acquisitions that have been done between one point and another on the S&P, you'll see that like half of those gains in the PE of the S&P are due to the fact that those stocks don't exist anymore. When you delete an entire company from the S&P, you're drastically lowering the amount of total shares. Then you put in a new company with new earnings, goes into the S&P. All right, and their shares get added, yes, but that's new earnings. You've deleted a whole company's worth of earnings, especially, and the size of the mergers are now unprecedented. So when you have somebody who does like AT&T does a $20 billion acquisition, they've taken $20 billion worth of shares off the market, but they haven't taken off the earnings. They've just taken off the number of shares. The money's still there. It's now just part of AT&T. So it looks like AT&T, an S&P company, has much better earnings than they used to. And so that way you say, oh, look how good the S&P is. Look how great the PE of the S&P is. It doesn't make AT&T better. It doesn't make any other company in the S&P better. You're just messing around with the formula that you're using to determine it. That's why those things are bullshit when you look at those charts. You know, and they never, I mean, this is my whole problem with TA is all that. It just doesn't take into account the proper variables. Like, this doesn't take into account the changes in the dollar. It doesn't take into account the, the European charts. You can't tell the changes in the euro. You don't know the change in the money supply. You don't know the change in other relative buying power. In other words, right now home prices are, well, they're not really flat. I mean, home prices have gone up quite a lot from the bottom. So if I was going to buy a $130,000 house in 2012, all right, if the market went up to $2,000, that's almost a 50% increase. So if the market gained 50%, it doesn't do me any good if the same home I want to buy is now $200,000 instead of $130,000. I didn't make anything. You know, same thing for a barrel of oil. If a barrel of oil was $130, not that it is, but if it goes from 130 to 200, if gold goes from 1,300 to 2,000, then what are you gaining when the S&P goes from 1,300 to 2,000? You gain nothing. All right. So Jim says financial engineering, and that's exactly what this is. And what we have now is a worse kind of financial engineering because what they've engineered is they've engineered a rise in asset prices, in stock prices, that does not correspond to a rise in the buying power of the people. So what has happened is that a person with a $130,000 home in 2012, and if that's their primary asset, as it is for the bottom 80% of the country, right? If they're lucky enough to have a home, yeah, corporations and people too. That's right, Mike. Don't get me started. But a human being who has a home, and it's a $130,000 home in 2012, okay, that's his primary asset. For almost everybody who's not in the top 10%, that is their primary asset is the home. And even people in the top 10%, a lot of us that's our primary asset. We might have $1 million home, might be a very nice home, but still it's like I don't have $1 million in the bank, but I have $1 million house. So it's good. I'm a millionaire, but I don't have $1 million liquid to throw around like that. Now, if a person doesn't have $1 million in stock and $1 million in a home, or even, in fact, I'm sorry, even if a home is a big portion of your asset, then that asset hasn't kept up. The home is maybe, if you're lucky, has gone up about 10% to $145,000, right? But the market has gone up 50%. So what's happening? When I do eventually sell my home and I have to turn into a pensioner, right? And I'm ready to move out of my house and get an apartment and live in my old age and try to live off my assets that I've accumulated over my life, then all of a sudden I can't get a good return because all these stocks went out of my reach. I'm getting much less stocks for my money. I didn't have the option in 2012 to sell my home, and aside from people being upside down in the mortgage, I'm talking about people who haven't retired yet and whatever. So you don't have an option in 2012 to sell your home, and now you sell your home, but you can't afford to turn that into the kind of stocks that are going to pay you the dividends you need to live on. And let's not even talk about putting money in the bank. That's a joke. They give you water, they give you 0.25% interest. If you get a long-term bond, you'll get 2%. So this guy's got $1 million and he puts it in the bank. He gets $20,000 a year to live on for tying up $1 million. You really don't have any choice but to chase assets. You have to chase dividend-paying assets, stocks, and things like that if you're old and need money. What else are you going to do to get money? You're not getting a raise from Social Security. Your company pension could have gone bust. It's a terrible situation we're putting people in. And now I'm acutely aware of this because I'm 51. And what year is this? Yeah, I'm still 51. Okay, good. So I'm 51. My older brother is my stepbrother, but he's just turning 60 now. He just turned 60 this year, in fact. And my second oldest stepbrother is 59. So they're seriously into the retirement mode. Like now, they're really looking at like, oh my God, I'm only going to work like 5 years, 10 years tops, and I got to have enough money to last the rest of my life, which could be another 20 years. And that's freaking scary. And I know a lot of you guys out there are in the same position. When it used to be, if you knew you were going to get 5% back in interest, or at least if you got it in a savings bond, if you've got a 30-year note and you got 5%, 6%, at least you know for $1 million you're going to get $60,000 a year back, and that $60,000 is $5,000 a month, plus a couple of thousands in Social Security is $7,000 a month. So you're not in terrible shape. You can have a life. You can go live in Florida in a little small apartment for $70,000 and be okay. It's not the greatest, I mean, you feel like if you have $1 million, you kind of get annoyed by that, but that's all you get out of it. But, that's it's still, at least if you had $1 million, you knew you could retire, if you could push away $1 million. Now, what could $1 million do? You can't live and retire without eating into that money in the bank. All right, so that's why, thing number one is that's why these strategies are so vital to learn. We kid about it sometimes, and we talk about it in chat, and we say, oh, well, it's more fun to make money quickly, and blah, 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 and whatever. It's all great when you're young, but as you get older, and I'm getting older too, maybe that's why I kind of get more into these strategies, but as you get older, you start being like, okay, let's now I understand what Buffett would always say. Buffett's rule number one is don't lose money. He only has one rule. His rule number two says see rule number one. Buffett says don't lose money. That's his primary goal in investing. And as you get older, and he's been older for 40 years, he's been older technically. So, so he's been my age for 40 years at this point. So as you get older, you start thinking a little bit differently about the money and about your future earning potential. Like, Buffett didn't know when he was 50 that he was going to be 90 and still running around working. He probably, at some point, around 50, started thinking like, well, I'm only going to work 20 more years at the most, and I've got to retire and do something right with my money. And a lot of his friends, obviously, are in that age bracket. All right, so like I said, I'm acutely aware of this because of my brother's friends. It's always an abstract of your parents, it's like your parents are your parents. But when it's your brothers, you kind of start thinking about it really seriously because I'm sitting there planning the stuff with them. All right, so that's why, these strategies, especially when we look at like our butterfly portfolio. Oh, where am I here? Hang on a second, got to log in. When we look at the butterfly portfolio, which is one that generates a steady amount of money for you with a pretty low variation. I'd say right now it's probably at a low cycle because of the drop-off. Let's see. Look at speaking of short-term. See, this is the thing. The short-term gains are fun. This is up 56%. But it's dangerous. It could be down 56% too. I mean, these were very directional bets that we took. Butterflies, here we go. All right, so 18.7%. So we're having a rough month, and it's still up 18.7% for the year. That's all you got to do is make 10%. And you're doing good. Even if you're working on retirement money, hopefully you have 10 years income saved up. And if you don't, you got big problems when you retire anyway. But hopefully you can have 10 years income saved up, and that means when you get 10%, you're going to get you get 1 year's worth of income coming back. You're still making a year's income. That plus some supplement from Social Security, plus you got your Medicare now because you don't have to pay your health care costs anymore, unless you want better care, of course. And then you lower your expenses. You have to lower your expenses when you're retiring. I never understand people who retire and still spend what they spend when they were working. It's crazy. You know, unless you've got oodles and oodles of money, it's not a good strategy. So we have the butterfly portfolio, and these are just, you know, I mean, again, every month we just keep selling and selling and selling. And as these positions mature, we are able to take more of them. So still, hopefully, we did not have a good month last month because the market went up so strong on us. You know, from what we sold in August on the rollover, we had a big bump into September, and that caused us to have a lot of things that didn't go well in September. But now we're back in good shape. We stayed in a fairly bearish stance, and now we just got to wait for all these things to start fading out on us, and we'll see what happens. Let's see. And we'll see how the $25,000 portfolio is a huge turnaround. Like in 2 weeks ago, it was doing terribly. Now it's back to 15.7%. And why is that? Well, there's two reasons. First of all, it was very bearish, and when the market was up, you know, 2 weeks ago. Not last week it was up 2. We had a Tuesday was up, but the week before that it was up 2, and that's when we closed out those things in the 25,000 portfolio. So we fortunately stayed bearish and we stuck to our guns and we did this, and now we got out, so we're not so exposed. We're still short GMCR, waiting for them to finally die. We took this chain as short, and why does that say 0? What? 10 puts. We didn't buy the 10 puts, did we? That's the wrong thing. I swear we didn't buy the 10 puts. Anybody know for sure on Janus what puts we did buy? It wasn't the 10s. That's something weird there. 14 puts. Thank you. Okay, so that's wrong. So we're actually doing better than that. This has to be fixed. I don't know why it says the 10s. And on Yahoo. Oh, is that because we sold some of them or something? Did we partially cash out of those? I don't remember what we did. All right, we'll figure it out. And the Yahoo, we have the bullish spread on Yahoo, so that's just in progress. So that's going good today. We go up a little bit. That's a $25,000 portfolio. We looked at the short-term portfolio. That's up some crazy amount, like 56%. So you're forced to do this, though. But if you're going to be forced to put your money in the market, that doesn't mean you should go crazy with the risk. All right, you know, just to see, this is the point. You have to have an appropriate strategy, considering the fact that you're forced to take your retirement money and try to leverage it into making something more than what you're getting in the bank. You know, but you can't just pray for something to happen. That's not a good strategy. I mean, every year you don't do what you need to do. It's a bad year. So we're still at 587 here, and then 587 plus what did we say in the other one? 56. So 587 plus 156 is 743. So it's a little light. I'm not happy with the mix at the moment. We're a little bit light, and that means because we dropped down from like 750 something that we hit it as a high. So we've dropped back on the combined portfolios a bit. Now, there's various reasons for it, and I don't freak out intraday, but we have to watch in case maybe we might be too bearish still. Might be too bullish. I'm not sure which way it is. Because the way today is going with this kind of chop, I don't know if we're too bullish or too bearish, frankly. It could be one or the other. And we'll see. Now, the short-term, the income portfolio, we made some adjustments, and that's going to look like hell. I'll tell you that before you can see it, because when you take new positions, you get penalized for the bid and ask spreads. So all the new, zero, look at that. So all the new positions that we moved to, we did a lot of adjustments. You guys should have gotten 3 emails yesterday, or 2 yesterday and 1 this morning, I think, of adjustments to the income portfolio. There's a lot. And this is the new and adjusted portfolio. We spent, the biggest thing we did was we spent $30,000 on a new Apple spread, this one. Was it $30,000? Yeah, it was. These are about $10. So we spent 63 minus 31 is $32,000 on a new Apple spread, and already it's down $1,000. See, that's what I mean by new positions. It's not really down $1,000 because we're bullish, and Apple's up 66 cents. So there's no reason for it to be down $1,000 except we're being penalized $1,000. So 3% is our penalty for entering the position. But that's normal. That just happens with options, so you get used to it. Anyway, so I did a very, very detailed review of these. All these positions are lovely. We're very happy with them. And you have to realize the purpose of the income portfolio, we have $471,000 of cash. That Apple money that we just spent was using $30,000 of our cash to potentially get back $90,000 if all goes well. At 120, these 30 contracts will be worth $30 a piece, $90,000. So that's a hell of a lot of upside potential, and at 100, they're already worth the $30,000 we paid for them, pretty much, close enough anyway if they expire here. So we're giving ourselves 2 more years, and in 2 more years we can make a substantial $60,000. We can double and double again over 2 years. So it's a very good use of our money. And if Apple goes down, what are we going to do? We're going to sell puts. We haven't sold any puts on this yet. We don't, we don't need to. If Apple goes up, there's no reason to ever sell puts. If Apple goes down, we're going to want to sell some puts to cover, and maybe we'll roll the position and change it. But for now, there's no reason to take the risk, no reason to do anything at all. We also have another Apple position that's quite large already. And one of the reasons we wanted to get more bullish is because we still have these October 84.29 calls that we're going to have to do something about come October. And they're down $25,000 on us so far. So we'll see what happens. But most likely we'll have to roll them, and we want to roll them into more premium. And now we have 100 long positions and 35 short positions, so about 1/3 short. So essentially we got more bullish on Apple since all this garbage came about with all this nonsense, because it really didn't amount so much on the whole of the bending and all that. And I wrote about it on this weekend also about that. And it didn't amount to much. It's not affecting the sales at all as far as anybody can tell that I've seen the report so far. And really, I think what it has done is it stopped Apple from zooming up to 110 on this news. So I'm in love with this spread. I think if you can buy a 90-120 bullish spread on Apple, what you're essentially doing, Apple's at 100, so you're buying the spread. We spent, let's see, that would be 2050, so 1065. So we spent 1065 for a $30 spread. That's 1077 in the money. And it always cracks me up. I'm always like, why would you buy the Apple stock in the hopes of getting a 20% gain and lay out $100 when I can lay out $10 and get the same I can get the same $20 gain for $10? There's no penalty whatsoever to doing this versus owning the stock, and that's true of many, many bull call spreads. If you look at any stock you're thinking of buying, you can almost always find a bull call spread that's better than owning the stock. In which portfolio, Jim is asking, do we have the short January 17 $80 puts? I believe that's this one. Nope, it's not. We have the short 87.14 puts. So I imagine it must be the long-term portfolio. Let's take a look at the long-term portfolio. And again, I can't stress enough how next year you guys will see, I mean, unless the market does anything really freaky, unless we have a black swan, either black swan up or black swan down, but as long as the market stays in like a normal 10% plus minus range, you will start seeing these portfolios kick into overdrive next year, because a lot of the positions start maturing. And once they mature, we end up owning a position with almost no premium, and we're selling all premium against it. This year it's a little mixed, because to get into our positions, we had to buy some premium. But next year, a lot of these, as positions mature, you're going to see the real power of this thing. There we go. So here we sold 20 of the 2017 $80 puts. We sold them for $830. Should we adding bull call spreads here? No, we have 2 Apple positions here already. We have this one, and there is a bull call spread. There's an, oh no, you have $80 calls. I'm sorry, yeah, we have an 8100 spread here, but it's 2060. That spread is now $11, okay? It's going to be 20. This 11 will turn into 20 at 100. Well, that's kind of better than 11 that's going to turn into 30 at 120, right? So this is kind of money in the bank on this portfolio. We don't need to do anything. Not only that, but we're also going to pick up this $7,000, $8,000, because currently it's charged $8,000. Well, I'm sorry, it's 20 of them. Currently, this is charged $15,000 against us, and if Apple is over 80, we get that money too. It's a lot of money. All right, and we don't want to get super aggressive. This is our long-term portfolio. We don't want to end up owning too many shares of Apple at $100 a thing. If we have 50 shares of Apple, That's $500,000, right? 50 contracts. So that'd be 5,000 times 100, $500,000. We don't want to own $500,000 worth of Apple. But if you don't have Apple bull calls, I like the 2017 a lot. This one's good too. This one will double in 1 year. This one's going to double in 1 year. The other one's going to triple in 2 years. So it depends on what you like. Are we going to just CLF in the long-term portfolio? Yeah, I guess we will. There wasn't an urgency to that. I mean, you know, when your portfolio is up 17.6%, it's a little less urgent to worry about the adjustments. But obviously, any adjustment we made in the income portfolio would apply to a position we like in the long-term portfolio. There's a lot of similar positions. So we have Cliff, we have GTAT, we have Lulu, they're in both. We have Toyota in both. We have ARO, I think, is in both. Apple is obviously in both, but that's a different sort of set. Annaly, and we have Annaly in both. So, you know, a lot of repetitive positions that we will be making similar adjustments to. But it's a little different with the LTP because the LTP is also more aggressive. The income portfolio, I'm trying not to lose money. We're keeping our cash. This is the first year doing it. In the first year, we just want to set up positions that ideally would pay us a dividend down the road. Now, the problem in the income portfolio right now is we haven't had a chance to own a lot of stuff because things haven't really gone that badly against us. When something goes down in the income portfolio and it goes lower and we double down and it goes lower still, we actually do want to buy the stock because we want to own stocks and sell calls every month and make an income until we're called away. That's the goal of the income portfolio. All right, we're fine this year because we collected so much money and we could live off the money we collect. Because ideally, we want to generate 10% a year in cash and live off that cash while the positions grow. In the first year, it's tricky, but once you get it going, you'll see next year we're going to sell a lot more calls on these positions because we don't mind being called away anymore. And when we don't mind being called away, we get to sell calls and sell calls and sell calls. In fact, Craig, usually in Vegas, does a thing like that. Oh. Speaking of Vegas, hey, where are we? Here's today's post. Wow, that was loud. What was that? So here's today's post. For all you guys, I mean, everybody here should know about this anyway, but I'm just going to post it just in case. It's not today. Oh, you've got to be kidding me. It was last week. So I pay attention. I can recognize my own post when I see it. I didn't recognize the title, but as soon as I looked at the post. There we go. All right. So right here, copy that, and that's Las Vegas. There you go. All right. So you guys want to come to the Las Vegas conference, that's the link. And I was going to say, so Las Vegas, Craig does a really good presentation on that steady monthly option selling strategy that he likes to, that he prefers to do. And that's perfect for a retired person. That's the kind of stuff you want to be able to pursue because you own the stock already, you bought them cheap. And how do we buy them cheap? We buy them cheap because we sell puts. And when it goes lower, we'll sell some more puts. So basically, we're not even going to buy a stock until it's down about 40% or 30% on us. That's the webinar link. Ah, you're kidding me. Damn, I'm stupid. Okay, sorry about that. So much for my reading skills. Let's see. There it is. Copy link address. Okay, sorry. Okay, really? Las Vegas. Okay, sorry about that. That was silly. All right. So anyway, so Craig does this great presentation, and he shows you like the steady option selling strategies that we're going to be using next year on the income portfolio. We're not using this year because we're just trying to establish some damn positions, but nothing goes down. Nothing goes down. We don't get a chance to buy anything because nothing has gotten cheaper than when we first entered the trade. So instead, we end up in sort of like a regular option strategy, kind of like the long-term portfolio. The income portfolio ideally shouldn't be like the long-term portfolio because we're trying to establish long-term positions, not necessarily with options. So that's why in the long-term portfolio we're using in the income portfolio we're using none of our buying power. In the long-term portfolio, we've used well, we have more cash than we started with, but we're using $300,000 in margin. In the income portfolio, so figure we have actually we now have $1.2 million in buying power, and we're only using $300,000 of the margin. So we're actually, forget that, but this is calculated by power options. They don't give you any margin. At a broker, though, obviously you get 2 for 1 on cash. So here we would have about $1 million of buying power, and we're using $119,000 in margin. We're using 10% of our buying power in the margin. All right, so we're barely invested, and we're barely invested though because the point of investing is we sell these puts, and we're saying I'll buy Disney if it gets down to $70 minus 5, 65. Well, that's not happening. I'll buy FCX if it gets to $30 minus 5. That's not happening. I'll buy GoGo if it gets to $17 minus 2. That's not happening. So we're not getting a chance to buy things. We did buy ABB, CLF, GT, AT. Annaly, Ocean Power, and Exco. No, these guys are terrible for us so far. And we'd like to buy, very much like to buy, I would like to own BTU, I'd like to own CLF. And notice, see here, we pressed our CLF bet. We're up to 30 now. So if it all hits the fan, we'll end up owning CLF at 10. I'm very happy to own CLF at 10 because what's going to happen if I do? Here's what we did. See how you got a $12,000 credit, a $5,000 credit, $11,000. So that's 11 minus 17. So figure about a $6,000 credit here. So that's about $2 a share. So we're going to net into CLF at 8 on 30 shares. So that's $24,000. That's going to tie up $1,200 in margin on CLF. If it all gets assigned to us at net 8, right? Then what are we going to do with CLF if we own it at 8? With CLF, if I own CLF right now, my net was 8. Well, it's a 10, so that's fine. All right, what am I going to do? I'm going to look ahead, and I'm going to say, okay, well, I'll sell the January, this January coming up, the $12 calls for 75 cents or 80 cents. So what does that mean? Now I've got 3,000 shares. 3,000 shares. We pay $24,000, and we're going to sell for 0.80 for 1 quarter. I'm going to collect $2,400. That's 10%. I want you guys to wrap your head around that. That is 10% of our stock we are selling each quarter in premium. All right, so all you guys, in fact, just today, somebody said, oh my God, I got CLF, blah, 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 blah. It goes down, I buy more. It goes down some more, I buy more. I want CLF because they pay a huge premium on quarterly sales. If I'm nervous about CLF, then I would sell the 2016 $10 calls for $2.50, and that would knock my basis down from $8 to whatever, $6.50, $5.50. Sorry, it would knock my basis down to $5.50 with a call away at 10. So if you're nervous about cliffs, you can do that too. And even then, you're going to collect $3,000 times $2.50, $7,500. You're going to collect against your $24,000 for 1 year, or a year and a quarter, let's say. That's the beauty of these things. Our goal in the income portfolio is not to win. Our goal is to get cheap stocks, and as we build a portfolio of cheap stocks, and as it matures, and it doesn't mature in 1 year, that's the problem, we've only been doing this for a year. As it matures in 1 year, as it matures in a few years, then you start getting these incredibly low basis for your stocks, and then these options that you collect on them are outrageous, and then you're collecting that retirement money. That's when you're collecting 10, 20% a year just from selling calls against your stock. And if the stock gets called away, okay, so now you have more money and you start selling puts again and you go back to that cycle. It's a beautiful, beautiful thing, but you got to watch it happen over, unfortunately, years. There's no quickie system for this. It's something that you learn over time. But I got to tell you, even if you're like 30, 40 years old, now's the time to learn these strategies. Just because you have time to mess around and do cowboy trading and stuff doesn't mean you always should. you should at least run a good, you should always be running like half your money or more in a retirement type account because you need steady money. If your short-term trading gets wiped out, you've got to have other money. All right, that's my commercial for safe trading for now. All right, let me get a couple of questions done. Okay. With BTU December calls down less than 10, should we close it? Yes, I don't know where you're referring to, Pat, but if, yeah, any call when it's down less than 10 cents, you got to think of the reality of it, because even if you come up to like a week before expiration, it's still going to be 10 cents. So what's the point, right? I don't know what call you mean or what portfolio, or, but let's see, BTU. Maybe you're saying so now. Let's see. It's in the butterflies. Okay. So here's the thing. So if you got the BTU December, I assume you mean this one, the 16th. So they're 10 cents. They're not doing us any good. BTU's at 12. If you think about it, how many days does it have? 80 days. So call that 3 months. So in 3 months, you're going to make a dime by sitting on this call, right? But if I close this call and I sell the 13s for 60 cents, then I'm going to make 20 cents each month as the premium decays. So it doesn't make sense to sit on the dime when I can double my take next month. And you say, okay, well, you're capping your exit at 13, but I assume on BTU we must have a put that's deeply in the money. And if that's the case, then anything this gains is going to be offset by that. The point is to sell more premium while we can. And I almost might want to sell these 12s for a buck, but I really, really don't think BTU is going down. So I would say yes to taking it off here. I kind of am inclined not to actually recover right away. But again, I don't want to make these decisions right now. We'll make these decisions when we look over the portfolios on Thursday. We do usually I try to do once a week or once every other week, and I think we'll look this Thursday. But if something's a dime, then yeah, that's a good time to take it off. It's not doing you any good. It's going to be a dime. Well, look, in fact, here, we're talking about the 16s, right? So if we look at the October 16s, well, they're a penny. Okay, that's not so bad. Let's see, November. The November, here, these are 8 cents to 0. So I don't know, the last sale was 4. So they're a nickel in 50 days. So in a month from now, you're going to be lucky to gain a nickel on those spreads, on those short calls. A nickel. It's not worth it. You're not doing yourself any good. You're using as much margin as you on that too. So yeah, it's always better when something gets to a ridiculously low point. That's when you want to get out of it. Depends on your trading costs. It depends on what else you want to do. Now, part of my attitude about these calls though is right now I don't really want to immediately sell a short call because I think BTU should be bouncing back now or in the next little while. I've thought that many times before though, so I've been wrong. But on the whole, I do believe it's going to start bouncing back, and I would prefer to sell maybe the 14s instead of the same price if we get there. If we don't get there, okay, then I made a mistake and I'm going to be out 20 cents, right? That's how much we expect to gain in a month is 20 cents. So I'm taking a 20-cent risk that I think BTU is going to go higher. That's the way I look at it. In which portfolio do we have the short? Oh, we did that one. How do you manage to get all these charts in the same window? I had TOS and they managed up to 4 charts. Ah, that's a great question. Okay. I'm not going to use well, I don't want to mess around with this tab. Let's see. If I go to Trade Futures. Ah, here we go. This one I don't care about. You see this thingy here? You go to that, and you make any size box you want. So in other words, if I make this, it's going to give me, and then you click on it, it's going to give me that many boxes. See how that works? And if I make, a more reasonable amount, like 9, it gives me 9 boxes. See how it does that? And resizes them and everything. It's nice. Now, here's another trick. You want to get you want to format one box the way you like it. Then you hit the right button click. You go to Style, and you say Save Style. Then you name your chart, right? Then when you go to the next chart, you go to, whoa, wait a second. It didn't work. You right-click on that chart, there you go, and it says Style, and now you say Load Style. I only have one style saved, my 3-day. Watch what happens. See that? Isn't that nice? So it's kind of annoying that you have to do that to every single chart, but you do. Every time you redraw your charts, you have to resave, you have to reload a style on every chart. But it's a lot nicer than having to deal with every chart individually. And then once you do save it and you are happy, then there's like a global savey thing, and now you lost me because I frankly don't do those sort of things. I mean, I know I save the setup when I'm all done and happy. Shoot, what'd I do? Oh no. I just caused some horrible damage to this thing. All right, that's why I didn't want to mess around with the other ones. Idle clicking is never a good thing. So, you know, then in setup, you just save your whole setup, and you can name your setups too. So I got a 4X and a Fill 20 and a webinar setup. So there's all these different ways to save stuff. Meanwhile, what is happening in these charts? Let me finish my questions first. All right, so 4 charts either on TOS toolbar. Oh, somebody actually answered that. Nice, Pat. Thanks. All right, good. I'm caught up on questions now. Look at silver. Very fun. So silver got all the way up to like 17.15. And we went long on it earlier. That was a huge winner there. Gold, well, let's see. What the hell? Well, gold went higher than that. Gold went to 12.12. We picked it up over here at 12.05. It's kind of weird. Hang on a second. I got 12.20. Why don't they have 12.20? My other computer is showing 12. Oh, because it's blown up too much. There it is, 12.20. I'm like, I know it went to 12.20. That's what it looks like. Okay, sorry. So we went long on gold early this morning. And by the way, for those of you who are new, let's take a look at what we do here. This is our job in the mornings. So here we are Monday, and I'll give you an idea what my day is like. 1 a.m. Yeah, that's me. 1 a.m. Okay. So when you see news, this is me reading in bed usually, or getting up at some point in the night. So so what happened is I got up about 1 o'clock, and it's just it's a me thing. It's like if I think the market is going to, I don't set my alarm or anything. It's just like if I think the market is going to do something interesting, it kind of makes me wake up in the middle of the night, like I'm excited to take a look and see what happens. And I'll tend to put on Bloomberg, and or if I want to be nice, I'll just look on my iPad and be very quiet. But so when I look on my iPad, I go to Bloomberg. That's a reflex practically for me. I always look at them because they have good charts and stuff. Anyway, so for an hour, so I was up for a little while, 1 o'clock, and I put up the news that I saw that was interesting. And of course, this is what I do. I'm reading news, and if I see something that I think is interesting, I'll put it up so if anybody else is up, they can read it. And so I was up until about 1:30, so I'm up for about a half hour. Then I decided it wasn't all that exciting. I went back to sleep. So here's what I was seeing at the time. Right here, all right? So when I woke up, it looked like this. Had it been up here, I would never have gone back to sleep. But I was it was boring, and it was flat, and I went back to sleep. Now, actually, it did work out, though, because when I woke back up at 6:30, everything was very exciting again. And let's see. So here's my comment. Takes me a while to actually post it. See, if I write these comments, it takes me a while I'm looking to post it, but here it is. So it's by 6:59, what I put up was the dollar was the big thing because the dollar was up 0.7%, and that knocked the commodities down. We had gold, whatever. So of what I was looking at, I said CL makes a good short below 94.50, and boy, did it today. Holy crap. Is oil. Look at this. So here I am writing at 6:30, 7 o'clock in the morning. We're at the 94.50 line, and then boom. All right, that's a $3,000 move in oil from here to here. All right, so we caught it. I think I got bored personally here at 92.50. I was happy to take the money off the table, but it went down another dollar here. I'm sorry, it's wait. Yes, 94.50. So 93.50, I was happy to take 1,000 off the table. It actually went flying down from there also. So fantastic gains for people who stuck with it. What did we see also? We saw So every day, if you're into futures trading, the first place to look is at the end of the day's chat, because this is where I post my morning thoughts. Like if I'm up, I'm always looking at the futures to see if anything's worth trading. There's nothing worth trading at 1, but as soon as I got up again at 6:30, I said, oh, look, that stuff is happening. The Nikkei was high at 16,250. All right, and here's the Nikkei. Very nice, right? Whoa. So here we are. Here's me at 7 o'clock saying the Nikkei is too high at 16,250. And we get this nice move down to 16,150. All right, so you get a 100-point move. You got to be happy you take your money off the table. That's exactly what we're looking for in these things. You know, you're not looking, you don't want to, yeah, everything doesn't have to be a $1,000 win. That's a $500 winner. That's fine. That's plenty of money. Especially because you can do them over and over and over again. Silver long at the time was 17.25, but if it fails that, like 17.2, these got updated, and go to 12.10 if they fail that. So we're looking for tight stops here. These failed. Our initial entries failed, but then we got down to where we wanted to be, and I think I updated that in the post in the morning. Then we talked about some other stuff, and I answered some questions. This is usually my morning, so what I do. Then we get into what happened today and this morning. So now we're talking about an hour later or so, because I'm starting to write my morning post. And I want to talk about, I always talk about whatever, I read the news, and then whatever I think is the most important, that's what I talk about. So in this case, eBay was really important, spinning off PayPal, and that was going to boost the NASDAQ, of course. We knew that. We had our levels. All right. In fact, how are our levels doing now? Take a while to look a minute. And then we talked about the euro and what's going on. We talked about the Nikkei was still shortable then. Wow, that's nice. And EWJ, oh, see, EWJ is going to be interesting. October 12 puts. Let's see how they're doing. You know, when I meant not to put things in the morning post because I'm not supposed to do it during earnings season. You know, usually we like make people subscribe during earnings season. I put too much free trades up, but you know, I'm on a roll and I'm writing, so if I see a trade, I end up writing it down. It doesn't matter where I am at the moment. So see, these guys climbed from 26 cents to 30 cents already. There's the last sale was at 26 cents. So yeah, that's not nothing. That's up 6 cents out of 20 cents in the morning already. These are nice, fast gains you get on these things. You know, and again, it's obviously the futures are better, or well, better is a state of mind. It depends on what you consider it. But the futures made $500 on NKD, and these guys made 30% in hours. So it depends what you call better. I think, frankly, if you look at the margin you need for the Nikkei, you probably need about 3,000 in margin for the Nikkei. So you only make $500. That's actually only like 15%. So you actually are doing better with these puts from a margin perspective. But personally, I drifted towards the futures in my own trading because it's so much less hassle. I can trade one contract, two contracts. I make all the money I would have made by trading 100 options, and the 100 options just with the bid ask and the commissions and things when you take these little contracts aren't worth it. So it's not that I didn't put that at 25 KP, but I just pointed out maybe something's going to go up. And gold got back to 1,200 by the time I was writing this, and see what we caught here on gold, if I can find that. Here's gold. So when I was writing, actually it was really 1205, but when I'm writing at 7 o'clock, here's where we were bottoming out on gold. You take the long off of that, and you get a 10-point run there, which is very nice. I think it's $332, no, $33.20 per dollar. So that's like $350 that kind of run on gold. All right, so it's good stuff. And here's silver. Even here, it's like it went up, it went back down. This is a huge move on silver, though. God, I mean, here we're catching this from this long here. If you put this at like 1710, let's say, 1710 to 1740 is 30 points at $1,500. But if you're greedy and you're stuck with it and you don't stop out, then you lose much more than that. You lose probably double that. But if you're smart and you wait for it to cross back over 17, you make another few $100 on this move. Futures is all about just being patient and getting in and out and taking those quick profits off the table. Meanwhile, this other stuff is all melting down. So let's see. So crude is getting killed. Yep, still get. Well, it's finding some footing down there, so that's not so bad. So yes, I'm very into SLW down here. I look long term. These metals will come back. Short term, they're being depressed purposely by the central banks for one thing, and also by the rising dollar. So in dollar terms, these metals are getting crushed also because the dollar is very strong right now. The dollar may continue to be strong for the next few months, but that doesn't mean long term I don't want to be in SLW. It doesn't mean long term I don't want to have gold. You know, this too shall pass. All these things change. And right now, Draghi, the ECB, is making some kind of a statement on Thursday morning, and Draghi's speaking after that. And Draghi's been like the W-ish talker of them all, but he hasn't really done anything. So everybody keeps thinking he's going to finally do something. And if he doesn't, Europe's going to go off a cliff anyway, because Europe's in bad shape. Let's see, Mike gave us a silver chart. Let's see what it looks like. Oh, can I not access that? Really? No, I can't. Interesting. What if I just click on it? Will the world explode? Nope, something comes up. Yeah, that's fine though, because it's always easy to say. That's nice. I wonder if we can go longer on that. W1. I mean weekly. Looks like weekly. Okay. I don't know if you can go further than this. No, you can't weekly, I see. But this is actual silver. And if you know, and the point about silver is the point about any metal is this happens at certain times. These kind of jumps happen. So the time to be a long-term investor is when it's like way, way low. And you got to have an attitude and say, look, I'm not saying put all your money into silver, but I'm saying if I have $100,000 and I want to put $5,000 into this, and if it goes down to 10, I'd put another 5,000 in, and if it goes down to 5, I'd put another 5,000 in, and then I'll have a lot of silver because then I'll spend. Let's see. I mean, silver isn't a share per se thing; it's the ounces. But okay, so 5,000 divided by 17 is 300 ounces. Let's see if I can remember this. So we get 300 ounces of 17. We get, okay, we get 500 ounces at, 300 ounces for $5,000. We get 500 ounces at 10 and 1,000 ounces at 5. So what I'm saying is I'm willing to spend $15,000, all right, to get, how many ounces do we say? It'll be 1,800 ounces, 1,000 at 5, 500 at 10, 300 at 17. So spending $15,000, and we're going to end up with 1,800 ounces of silver at an average of, I don't even know what it's 15,000. So it's an average of like $8 or something like that per thing. So what I'm saying at 17, when I start allocating my cash to silver or gold or whatever, it doesn't matter, right? Is I'm planning now to own a certain amount. So I'm planning now to say I'll make metal, you know, and if silver was my choice, I'm willing to make silver 15% of my portfolio. And by the way, when I say 15%, I mean 15% of my cash, not 15% of my buying power. That means if I'm going to eventually own it. And if I own it, and I own shares or something like that, then my buying power, in theory, that's why I like SLW better than actual silver, because I can still have buying power. But if I did that with SLW, I own it. And if I own it, then it only costs me half my margin or less, depending if you have a portfolio margin account, which means I'm only going to be tying up, instead of 15,000, I'll be tying up $7,500 to control 1,800 ounces of silver. Now, if silver goes back, if my 1,800 ounces of silver goes back to 20, that's $36,000. Do I care if silver goes back to 20 this year or next year or the year after that or the year after that? No. And especially, and again, this is the big picture stuff, guys, especially because on SLW, wait, let me get back to that chart. Okay, I can probably change that to SLW, or is this doing, let's might screw it up. All right, because it might be only a futures chart. Let's see what it goes. Yeah. All right, what I wanted to say was if I do SLW, instead of actual silver, they're actually right, very close to where silver is. They're at 20, same thing, same lows, same everything else. In fact, let's take a look at that chart. I'll show you as a comparison. So you see that, how that trickled out between, look, concentrate on this part, between 2011 and 2014. And here you see the same thing, 2011, 2014, it's just dribbling down, blah, blah, blah. Looks terrible, right? So with SLW, what am I going to say? Same plan. Remember that. It's the same plan. So I'm going to allocate a block. So if I have $1 million buying power, my buying power allocation is a $50,000 block is my max allocation. I don't want any position to be more than 5% of my portfolio generally. I'm willing to make it 10% if I have some particular faith in it. In other words, in Apple, I'm willing to make Apple 20% of my portfolio if it goes down to $50. So knowing that, it means I'll take a bigger allocation up front. So I don't, because certain stocks, I don't care. You know, certain things, if they you know, like if Boeing fell, you know, if I'm buying Boeing, and Boeing is like God knows what now, but let's see. Boeing's at 127. So if Boeing, if there was an airline crash and Boeing went to 60, I want more Boeing. Why not use AGQ? What's AGQ, an Ultra? Yeah, you don't want to use an Ultra. Not for a long-term play. It's Ultra, yeah, I thought so. So no. The Ultras tend to decay. So something like Boeing or something like GE or something like that, I think certain stocks, if they crash, I just want to buy more. And Apple's one of those too. So some things you want to allocate more. Silver, I don't really think in the long term that we're going to stop using silver. I think frankly, if it comes down, here's another interesting thing. Gold at 250. The reason I started buying gold at 250 back in the old crash was because I knew that at 250, below 250, gold starts becoming a preferred metal for electronics. You know, the only reason gold is the best conductor in the world, but the only reason they don't use gold is because it's freaking expensive. But if it gets down below 250, it's enough of a better conductor that I'd rather use the gold than use other materials. You know, if you're a manufacturer, because you don't need much of it, it's so malleable, it's so durable, it's so conductive. All the properties of gold are fantastic for electronics, but it's just at $1,500, no. But at $250, yeah. And so back in 2004, I remember when this was, back in 2004, we were buying gold at $250 because that was crazy. All right, silver is also, it's used in manufacturing. And when you get below a certain price, other floors kick in that are not apparent to you now. And yeah, SLW pays dividends. Mike makes a good point, and they have cash flows. There's all kinds. They're a leverage play on silver already because they do. They have all these calls on silver, but they operate themselves. They're basically a silver fund. I mean, that's, you know, it's almost like buying the GLD ETF, except it's actively managed, and they do a pretty good job, these guys. So I want to buy silver. Let's just cut to the quick of that, though. So I want to buy silver, and I can buy silver, or I can take SLW, and I can sell the $18 puts, 2016 $18 puts, for $2 and, you know, well, $2.16 was the last sale, so call it $2.20. So I can sell these puts for $2.20, the $18 puts. That's already netting me into silver to SLW at 16. 16 is $4 below the current price. It's almost 20% discount to the current price. So what is my trading strategy? My trading strategy is I'm saying, okay, you know what? I'm going to sell 10 of these guys. I'm going to put $2,000 in my pocket of SLW, And now if silver goes below 18, I'm going to end up owning it at net 16. I can live with that, or net 1580 actually, 220. So I'm going to end up owning it at net 1580. If it doesn't go up, I'm going to keep my $2,200. Now, how much silver would I have to buy to make $2,200? You know what? I have to buy $5,000 worth of silver at whatever the hell it's at now, at 20 bucks. Where's silver? Ugh, my brain. I seem to have a limit, 17. Okay, yeah. So I have to, so if I bought at 17 bucks, if I bought $5,000 worth of silver, divided by 17, that's 294 ounces. So to make 2,000 bucks, silver's got to go up $7. All right, so 7 divided by 17, 41% for me to make 2,000 bucks on $5,000 worth of silver. But if I sell $2,000 worth of these, I'm committing to buy 1,000 shares at 18. I'm committing to $18,000, which is going to be $9,000 in margin. But I'm going to make 2,000 bucks if silver doesn't drop 20%. Or I'm sorry, 10%. I'm covered to 20%. I break even at 20%. So as long as silver doesn't drop more than 10%, I make 2,000 bucks. So essentially, I am taking more risk because I can be assigned 1,000 of these at 18. So I'll be assigned, I'm sorry, net 1580. So I could be assigned $15,000 worth. But the risk I'm taking is only if it drops. If it doesn't drop, let's see, sell. We'll sell 10 of these guys. I'm using $1,600 of buying power net to collect 2,100 bucks, 2,200 bucks. So I'm tying up no buying power. So, you know, a lot of people said, oh, you're tying up margin this and that. You're not tying up margin unless you buy it. And it goes back to what I was saying before. If silver drops 20% more from 17 down to 340 is going to be 15, 13, about $14. So if silver drops to $14, then I definitely want to buy more. But instead of buying 5,000 now and 5,000 later and 5,000 on the next drop, I'm going to just sell these. And if it drops on me, I'm going to roll to another set, and I'll roll to another set. And that's how I make my commitment to silver. And by the way, 2,000 is a lot. I mean, you don't have to be greedy, because obviously if I'm buying $5,000 worth, I'm not really expecting silver to jump 50% right away. This is telling me I'm going to make, this is going to tell me I'm going to make 2,000 bucks in 1 year. You know, we're sitting here saying, will silver recover to make a 50% or 100% in 5 years? I'm talking about 1 year. This thing's guaranteeing you the money. So you don't need to be that aggressive. You don't need to do that many shares. But I'm saying that if I have an allocation block of $50,000 in my income portfolio, in my long-term portfolio, I got no problem at all committing $18,000 to owning it here, or $16,000 technically, because I collect 2 up front. So I'm committing $16,000 here, because what's $16,000? It's only half of that. And again, I'm not even talking about portfolio margin, regular margin account. I'm only using $8,000 in buying power to collect my $2,000. That's 25% back in whatever it is, 16 months or 15 months. That's how you make money, guys. I don't have to reach for the stars. I don't have to get involved in these triple ETFs. I'm making a $2,200 return on $1,600 in margin, and I keep the majority of my portfolio in cash, which is what we're demonstrating it all year long. We keep the vast majority of the portfolio in cash so that if anything happens, if the market collapses and drops 50%, we've got a ton of cash sitting on the sidelines to start buying things with. That's when I want to jump in. When everything's on sale, I want to jump in. I don't have to jump in now. If you're not offering me cheap prices, I'm not buying. And that's where the income portfolio is now. It's not a great year for the income portfolio because nothing's going on sale. We only really buy things when they're on sale. When things are not on sale, we're not too interested. But even so, we are working our bases down. And every year, we're going to roll those puts lower and lower. All right, so let's see who else got a question. Oh, and SLW pays a dividend. I forgot about that part. That's important, too. Thank you. Yahoo. Let's see how much they pay. And so for dividends, we love that, right? So maybe we should put this in the income portfolio, actually. I think that's a good idea. We should probably do that in the income portfolio because we need it. Oh, 1% dividend. No, that's not exciting. 1% dividends are great. I mean, it's something, but it's not important. But down the road, as I said, though, if you work your way into a huge amount of shares down the road, yeah, then 1% is nice. All right. So where are we? Back to the future, see if anything interesting is happening. Shorts. All right. It's 2 o'clock now. Obviously, they're going to push it into the close. See this 1100? This is a good place to go long right here. 16.2 would be, I actually have it up in the Nikkei. 14.025 is obviously a good place to go long on the NASDAQ. 1965, if that breaks, we're in good shape. And 16.950, that seems to be holding on the Dow. Oil is dead as a doorknob. That's sad. Wow. I don't know what I know what the story was. Did anybody hear I think it was the EIA, I think it was our own energy agency, said that in a relatively short amount of time, like by 2050, we won't need oil anymore. I believe that was the report. Let me see if I can find that on Yahoo. I think they really moved up their projection for like how long until we're basically a solar society. And that's what started the big oil decline. Because people started realizing maybe they're not going to make their money. Energy, ETF, most important commodity. I know I heard it. Nope. Let's see. EIA solar. News. New solar capacity, solar generation, how solar can be the world's biggest power source by. That's the thing I heard. Okay. $20.50, right? That's what I heard. Oh, I'm sorry. So it's not totally, but that solar will be the world's biggest power source by 2050. That's what they're talking about. And this is the EIA projection. These are the energy guys. So they're projecting that we are here and that we will be here. And that's huge. All right, so that's the scale we're at, and that's without any major changes in programs or anything like that. So that's what they're trending. Current trends, use are unsustainable, economic environment, action, blah, 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 blah. We can and must change. Huh, who's saying that? Oh, that's just some other person. I was going to say that's not something the EIA would say. But anyway, so that kind of stuff really bums out oil traders. That was not a good thing to tell them. They don't want to hear that kind of stuff. So I think that's what caused the big decline there today. There wasn't really any other particular news going on in oil that I heard about. So that's just the overreaction. Now tonight, though, last week they had a big draw in oil, but it was really a draw because they shoved a lot of oil into the refineries. I laid that out on Wednesday's post, that they put a lot of oil into the refineries, and the oil didn't come out of the refinery. So basically inside the refinery, where they don't do inventory checks, there had to be a buildup of oil because you see more oil goes in, but less oil comes out. Therefore, inside the refinery, in that black box, there's a whole bunch of oil piled up. Eventually, that oil gets pushed out, and I think that's also warning us that today's report and tomorrow's report are going to show that you've got a lot of oil build in inventory, especially in the supply of gasoline and diesel, because that obviously is what the factory is doing with the oil inside. Can we show a 5-year chart of oil? I have been saying 85 for ages. Nobody ever listens to me. I keep saying it's going to go to 85, and nobody believes me. It's not 5 years, but this is a few years. WTIC. Doesn't tell you much. You know, here's oil. Goes up, it goes down. It goes up, it goes down. Generally, fair price for oil is somewhere around this $95 mark. But we're in a glut. We have a slow economy and a strong dollar. All great reasons for oil to be down at the 85 line, at the bottom of the longer-term trading range. Now, there's 75 down here, but I don't think the world, I think, you know, you got Putin and you got other stuff, you got the ISIL, whatever they call themselves this week. Yeah, I don't see that we're so relaxed that we should go to 75, unless, of course, China collapses. China could implode at any moment, and that could send oil flying down. But on the whole, I think I'm comfortable with my $85 prediction. And all we've got right now is a weak bounce. Well, it was a weak bounce, but now it's back to here, isn't it? But all we have is a weak bounce interrupting this nice little decline that was taking us to the $90 line. Of course, it's going to bounce off of 90. And now let's talk 5% rule, 107.50. Okay, we dropped from 107.50 to 90 is $17, and 20% of $17 is $3.50. So we expect to bounce from 90 back to 93.50. All right, where's 93.50? Well, right about here. That's the line we've been playing short. This line right here. See that with the fingers with these three guys that come in here? Then that comes to the top at 93.50. That's 93.50, and that's 93.50. That's the line we've been. That's why we play the 93.50 line. Well, it's just a 5% rule. It's not complicated. But we knew to play 93.50 here. We knew to play 93.50 when it was here. We knew this line. We knew it was a significant line. And as soon as it broke, it became our favorite line. And then we've had this wonderful consolidation. Was it oil we made a ton of money on last week, or was it the Russell? I don't know. One of those guys made a ton of money on last week on the decline. This is really obvious stuff, though. And so now the next breakdown goes back to 90. If it breaks 90, all right, then it's going to complete a 20% drop. So 107 and 20% of 107 is like 20 bucks. So you're talking about 87. I mean, I don't know, it'd be more than 20 bucks. It'd be 87, 86, 85. So that's the 20% retrace or pullback from 107. 107.50 to be exact. So, well, again, let's do the math just to be short because people like to know. 107.50. Although I got to tell you, when I do this math, it's silly because realistically, we're just guessing. You know, there's no law. 86. So officially, 86 is the 20% pullback from 107.50, which was our projected top for oil. So even when oil was at 112, we still thought it should be below 107.50. Up here, 107.50. Over here, 107.50. These were our best bets ever on oil. This year, whatever year that was, I was banging the table, I was screaming, I was shouting, I could not possibly tell people loudly enough, this is too high for oil. When it went over 107.50, I was screaming about oil. Boom, falls like a rock, right? Then it gets back to 107.50. It doesn't mean it can't go over just because we say something like, you know, again, I'm saying 85, although it's 86 is a real number, but I'm saying 85. It doesn't mean it can't go under 85. It can go under 85, but it's silly. When it starts going under 85, I got to start saying I want to be bullish on oil. But here at 107.50, we told you and we told you and we told you. Every year or two, we get these opportunities. And this is a phenomenal gains. You know, huge amount of money. A lot of the money we made in the short-term portfolio came from this kind of betting. So, you know, and now, as with anything, though, these are fundamental reasons. You know, we're talking about it and showing you a chart to have a discussion, but the reality is why? It's because this much oil is being pumped. These are your variables. You have this much oil being pumped. You have this much oil being used. You have this much of a tension in Iraq, and you have a tension in the Ukraine, and you've got and then you've got a certain amount of demand destruction going on with the solar panels, and also, by the way, Exxon and the Russian company just found a oil field, probably the size of the Gulf of Mexico, up in the Arctic. All right. So one of the great benefits of global warming is that the Arctic is no longer ice, and we can now take our ships up there and we can start drilling. So all these previously inaccessible oil fields are now becoming accessible, and they just discovered a massive field up there, like the entire Gulf of Mexico worth of oil up in the Arctic. So as the world keeps warming, I bet that's not the only one. I bet there's more and more and more that you'll find up there. So there's tons more oil than they lead you to believe. Sears, somebody's asking about Jim. Sears, all right, so we're off oil, right? We're done with that right now. The problem is down here, I don't like it long and I don't like it short. I expect it to go lower, and I certainly don't have any reason it should be going higher other than the normal bounce that we usually get into tomorrow. So tomorrow, if we're still down here, if it survives the American Petroleum report tonight and it doesn't go lower, then I'm going to like it tomorrow long into the EIA report at 10:30 tomorrow morning. So I expect it to at least try to recover into the report unless the API report shows a really, really big build that's unexpected. I think that if these guys are realistic, they expect a 2 million barrel build at least, maybe 3 million barrels. But as long as the American Petroleum Institute report late tonight is, I would say, less than 3 million barrel build, then I think they'll be able to hang on to 91, and then that should allow them, unless the dollar is too strong, but that should allow them tomorrow to bring it up back to 92 or maybe 92.50 before the EIA report. So if you want to play long, that's a good way to play long. If it's 92.50, it's going to be an incredibly tricky place to play it tomorrow. And like I said, these are all factors, the dollar factor, the report factor. You have to know what your variables are, and when they change, you have to change your position. You can't just pick a number and say, this is where it's going to go, because a million things can happen between now and then. You got to just constantly watch it. It's like driving a car and say, okay, I'm heading that way. And you can even point, like if you see, like from my house, I can see the Empire State Building. And I can point to the Empire State Building and say, that's where I'm going. But I can't just get in my car and drive straight to the Empire State Building. There's a road in between. So as conditions change, even though I'm driving that way, so even though we're driving to 85, I may at some point have to turn the entire opposite way because the road curves on me. All right? In fact, the funniest thing is you do that out west. When you're in the drive between Las Vegas and California, there's a lot of mountains in the way. So when you're driving, sometimes you end up turning so much that you're like going almost the opposite direction from where you wanted to go for a while before you can turn back to where you're heading. So here it's not that bad. We generally head in the right direction. But at any point during a journey, you have to go where the road takes you. You can't just say this is where it's going and expect that nothing's going to deviate during that time. All right, it's more like a road. You have to look at the variables. Sometimes there's cars in your way. Sometimes there's a traffic jam. Sometimes there's this. Sometimes there's a bridge. Sometimes it's a toll bridge and goes up, or a drawbridge. There's variables, and you need to be aware of these variables if you want to drive. And stocks are the same, guys. It's like you've got to understand the variables in your investment, and you've got to be able to adjust to them if you want to enjoy your trip while you're owning it. Even if you pick the right direction over time, even if you have good fundamental logic for what's going to happen, it doesn't mean you're going to get straight there. Things change every day. All right. Sears. Okay, speaking of variables. Okay, so Sears, the reason I was very big in Sears, we liked Sears. We got out of it when it had a big pop. I forget when it was, but at some point this year, Sears had a big pop, and we said, fine, let's get out of this stupid thing. And here's another problem in charts. The Sears we got out of, so I guess it was here, up around $45, we said, that's great, and we took our money and got the hell out of the stock. We didn't short it. We still thought they were okay, but what happened since then, they did the Land's End spinoff. Oh, that's what happened. Yeah, we got the Land's End, we got out of that, and then we ended up killing it when it took this little thing. So 45, we weren't doing it, but then when Land's End came out of it, it did this little dip, and or maybe it was this dip, I don't know, but one way or another, this is about where we got out. And the problem is this Sears here isn't the same Sears that was here. Land's End has been taken out of it. Land's End was 1/4 of their sales, and it got spun out, and it was all of their profits, basically. Well, I mean, all their profits. They were losing money, but it mitigated about 1/3 of their losses. It's like Land's End, they lose $300 million, and Land's End made $100 million. Now, you have just Sears losing $300 million on less sales. They have lower sales, bigger losses. That looks terrible. All right? And it's not just Land's End, though. They've also spun off some real estate to pay for that gaping $300 million loss that they have each quarter. They're spinning off and selling real estate assets. So this Sears here isn't the same Sears that was here. And that's why TA is nonsense, because how could you possibly have a chart how is this chart going to tell you anything when it's not even the same company anymore? It's like they don't have the same potential for revenues. They've given up stores. They've given up, they spun off a unit. They've taken the division that they can't possibly earn this money again. So why would it bounce based on the chart? It wouldn't. Yet people buy based on charts. It's the most ridiculous thing in the world to look at these charts and think they're going to tell you something if you don't, I'm not saying it doesn't tell you anything, but if you don't understand how the company functions, then it's pointless. And there's so many people who trade just on TA, it makes me sick. You've got to understand what the hell the stock does that you're looking at the chart of. You can't just trade based on a chart pattern. And when you think about how many nutcases out there have these systems that are based on identifying chart patterns, and they say, oh, based on this chart pattern, you got to break out blah, blah, blah here, and you got this kind of chart pattern here, so we should buy it. That's ridiculous. If I have a good company, and I know it's good, and I'm waiting for it to turn around, that's very different, right? If I'm looking at BTU, and I know all the reasons BTU is down, they're down because coal is out of fashion, because of the global warming and stuff. Everybody thinks everyone's going to crack down, so on and so forth. I made a case a couple of weeks ago about why BTU is bottoming out here at 13. It's below 13 now. It's 11.88 or 12 bucks or whatever it is today. But I don't care. Again, that goes back to the same thing. I don't care because we didn't buy it for 13. We promised to buy it for 12 or 11 or 10 or whatever the hell we did. But we sold puts and we promised to buy it for a lower price. So it's not that I'm buying it here. I'm still giving ourselves another 20% discount below that, which will be 10.50 or 11 or whatever it works out to. But we're giving ourselves a discount below that price. But here's where I put my foot down, because here's where we have value. And it wasn't just me, because look at this volume spike here. A lot of people saw the value here and jumped in. Or maybe that was just us. Maybe it was because I published that post. But a lot of people saw the value here and jumped in. And it didn't stop it from still selling off. But now you're starting to see that turnaround. Just like here, see this? Down, 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 and finally somebody puts their foot down, and suddenly you run out of sellers. And up it goes again. Where do I think it's fair? I think it's going to be fair to get back to about here on this about 15 here on the 50-day moving average, or 16, the 200-day moving average. And if it gets to that, we're going to have to rethink where we are. The faster it gets there, the more worried I'll be that it's going to pull back from that. But I like BTU because I understand why it's down. I understand why it should be going up, and I'm happy to sit there for the long haul waiting for it to happen. But Sears, I don't know what the hell's going on there. I don't know what's inside the black box anymore. So I don't want to touch it with a 10-foot pole. Yeah, that's right. If you want to bet on, yeah, that's right. The only good thing about the GOP getting the White House will be like the dirty fuel stocks will go flying. Why are you bullish on Lulu but bearish on XRT? Because, well, okay, here's a good one. Because XRT, well, I'm not as bearish now. XRT is now pulled back, so I'm happy. But here is my bear line on XRT. This is where I put my foot down to the upside. 89 bucks, in fact, is the exact price that we like to short. So I'm not as bearish on XRT now. I think that this is a more fair price for XRT down at the bottom of this range. So about 82, 83 is fair for XRT. Now, for Lulu, now again, here's a company that hasn't changed. So nothing here has changed internally, but look at this. They were making good money, good money, good money. There were many, 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 many people trading in this range from 60 to 80. Then they fell out of favor, and now they're close to 40, half price. Has the business changed? Well, let's go take a look at Lulu. Now, the main reason is competition, but has that competition actually affected their business? It's scary competition. It's like the Gap is competing with them now. But what's actually happened to these guys? Well, they had $1 billion sales. Now, don't forget, they were double this price when they had the sales. They had $1 billion sales here. They had $1.3 billion sales here. They have $1.6 billion sales now. They made $184 million, $270 million, $270 million again, quarterly. So this year, it looks like they're going to come out. Well, let's just average these without worrying about projections. So we got 4.9, another 4 is 13, and another 4 is about 1.9 billion. Right? Did I do that right? Yeah, 1.9 billion. And then they're going to make 66, 200, right, that's 170, 200, 250. So they're at $1.9 billion, and it looks like 250. Maybe I'm wrong about the Christmas quarter, but in other words, there's nothing. It's fine. So for my company that's got much more sales than last year, much more. This is more than 20% growth in sales, with at least flat profits to the last 2 years. At least flat, probably better, but I'm not, even giving it no benefit of the doubt, right? For a company that has $700 million in cash, 0 debt, it's getting better and better, right? $100 million dropping to the bottom line in cash. I'm sorry, that's annual, right? So $100 million dropping to the bottom line. What am I paying for this thing? $6 billion. That's not bad. That's like a P of about 20. And there it is, 4 Ps, 20.65. So, hang on, let's see what the question's on Lulu. So why am I bullish on Lulu compared to XRT? Because Lulu is one of the outstanding parts of XRT. I don't buy GDX, the gold mining ETF. We talked about that today a little bit. I don't buy GDX. We buy AVX. It's the best miner in the index. And if I'm going to buy a retailer, I'm going to buy the best retailers in the index, not just any old retailer. So if when I look at an index that's beaten down, I want to say who are the guys who are going to outperform their peers as things go up. Okay, so Russell's at 11,000. Too bad it's too late to make a bet. But right there, it's an obvious place to go long. When you touch that 11,000 line, you can take a long bet. You want to watch to see if everybody else is breaking down, but if everybody else isn't breaking down, then it's a great place to go long. Look at this, 1099.6. Look what a great bet that was. All right, so I tell you what, let's put a couple on, just see what happens. Blah, blah, blah. Here's the thing. Active trader. Here's Russell. Not hard. All we do is this. Oh, no, that's sell. Stop. Ah, you son of a bitch. I meant to buy and I sold. All right, so there's 2 longs. Now add another one, get a little lower. Nope, wouldn't fill it. Yeah, it'll fill. Okay. Not a good sign if it fills, actually. If it fills, it means it's probably not done going down. So now I'm at 100.30, and if I get below a little here, I wouldn't mind buying some more here to try to get right to that 1100 line if I can. So ideally, I want to get like 5. I wouldn't mind going 10, no long here. And what I'm going to want to watch is I would get out if this breaks at 16.930. If that breaks, then I'm going to figure this thing's really breaking down. On here, I don't want to see anything breaking. This is what I mean by tight stops. I want to see this 1961 line holding up. And oil, I want to make sure oil doesn't fail 91. So if that stuff starts happening, I'm going to get very concerned. But here, I'm pretty happy. And I'm trying to show you how you work into a play here. I want to be at 1100. I started buying at 11.050, and already my average is down to 11.00.30. And frankly, if I hadn't done that one stupid sell in the first place, I'd be better off. Okay, so here we go, 11.00, a little lower, or no? Yep, here we go, great. So I'm going to buy one more now. Whoa, now we're going to really test my nerves, right? So I want to buy another one here at 109.97. That should be just almost enough to get me down to where I want to be. Ooh, shoot, boy, can I jump on that? Seriously? Ugh. Every time I do a seminar, it's like the worst entries. It never works out. Oh, all right, now. Oh, you're kidding. Still not? All right, so I have 5, so I have to be at least 6 below to make it. So I'd have to buy another one at 109.94 to get that to below 11,000. So now I have 5. I really wanted to have 5. I said I'd go 10 if I had to, but I'm not. The way this thing's falling apart, it's not too safe down at 10. Look at that, 230 bucks. See what I spent for you guys? So nice of me. There we go. Now what do you do when you yes, profit. Yes. And yes. You see how that is? So now I'm happy because now I have 2 way down here. Actually, here's my average now. My average is below 1,100 because as soon as it bounced a teeny bit, I got back to 2. And you see how fast that profit turned around? So now I can relax and just ride this thing out. Although if it doesn't hold 11.1, I'm going to get out again. Let's see, we'll call it here. If I hit that, it's going to fill me in 2 seconds. So I'm going to hope it just holds up. And what am I playing for, by the way? What's my logic? I didn't really go over that. Into the close, I expect a little bit of a run-up because it's the end of the quarter. That's why I thought 11,000 would hold. That'd be a terrible end of the quarter if it can't hold 11,000. So if we're lucky, we'll get a nice run. But now I got a nice relaxing run. I only have 2 contracts, and I'm well in the money now. That's how you scale in and scale out of something. But if you scale in and forget to scale out, you're in big trouble because you can lose your money really, really fast if you forget to scale out when you scale in. The point is to lower my basis. And it's a very hard thing to fight off. I used to do the same problem myself. You get greedy. Because when it bounces from 11,000 to 11.01, you're like, oh yes, I'm gonna make $1 million. Now I'm going to double my projections of making money. It's like, no, the only reason I went to 5 was because I didn't like my outcome when I had 2. See, now I'm at 11.02, and now I think it's gonna be greedy, so I'm gonna just take another one. Now I got that off the table, 490 bucks already for the day. So now I could even, since I'm doing the seminar, I'm going to even set a stop here. So it's so far out of the money, I don't care. Even if this triggers, I'm still going to have 350 or so in profits now. If the stop never triggers, this thing can go up to whatever, and I'll just have to remember to flush my stop later. It's going to show me that anyway. All I have to do is get out of my stop, is click that and get out. But you see how easy that is? 450 bucks live. All right, so don't say this isn't a worthwhile seminar. So where are we? All right. I got to finish up now. It's already 2:30. So Tia, thank you so much, Xiao. You just made me 500 bucks. I really appreciate that. I hope you made everybody 500 bucks because that was pretty easy. So let's see. Lulu bringing their cash home to do buybacks. Yeah. Oh, right. Oh, yeah, that's right. That was one of the reasons we got kind of psyched about Lulu when they were lower before, because they're bringing cash home because they got, they're buying back their own stock. If nobody else wants it at that price, they sure do. And I'm not a big fan of buybacks really, but frankly, if you're Apple or somebody, or Lulu in this case, if you look around and you say there is no better use for our money than buying back our own stock. There simply isn't a better thing we could do with it at that price. If nobody's going to respect your company and you have a lot of cash, at some point you got to say, hey, I'll buy my own company then. You don't have to be forced to do some stupid acquisition or something to justify it. You think, if you guys don't like my stock, screw you, I'll buy it. Let's see, local Sears leased prime storefront to WFM. Wow, really? That's interesting. You see, it's now on the side entrance. Wow, that's embarrassing. Really? They leased out. It's smart, I guess. They leased to a Whole Foods, but they put their own thing on the side entrance. That's a little weird. I would have made them keep an open connection somehow, like to cookware. That's what I would have done. I would have put my cooking department in the back of WFM and had a whole sort of like a slide out thing where people go. Maybe it would be tough with security. I don't know. Still, I think that's silly. I think it's like there's a problem with these guys, a big problem. I tried day trading TNA for a couple of months, but the bid-ask spreads would kill us, so I called it quits on that. Right, Jim? In fact, yeah, we used to be into that stuff. Oh, look at it go now. See? Now I'm full of regrets. I should have kept it 2. But you see what I'm going to do now? I'm going to move my stop up. Here's 103. So now I move my stop up to 102 if I can find it. It's so far down now. Wow. So now I'm going to move my stop up and follow it. Whoop. So now I'm going to put my stop up at 102. So it's the same bet, but now I raise my stop. And so now I'm locking in like whatever, 500, whatever the hell it comes out, 2 gains. So I'm sorry, what were we talking about? TNA. Right, yeah, we used to play TNA a lot, and but the problem is, yeah, that's it. It's just the margin, the bid ask, and the getting in and out, and it's not all that liquid. Futures, I'm telling you guys, it's nothing to it. It's a simple thing, and that's how fast you can make money. You learn a few tricks and you can do this thing. It's just as good as trading these silly contracts. You know, the margin on this guy, let me take a look at this thing. The margin is $5,600 on a Russell contract. This is a heavy one. The Dows are, the Dow is 4,200. Who's the low one? The S&P is the low one. Oh, 5,000. They raised the margins. Those are all higher than they were. All right. So each contract, you tie up $5,600, but you only tie it up for as long as you're using it. You know, so you're in, you're out. The margin immediately releases and you have it back. So it's great, and the fees are practically zero. I mean, the in and out fees are a couple of bucks to get in and out of these contracts. It's so worth it. You know, if you know, and again, it takes a lot of practice, and you got to learn what you're doing. But they're not that bad, because if you start with like the Dow, I wouldn't start with the Russell, because the Russell's vicious. But if you start with the Dow, and you're happy to make your $100 here and $50 there and whatever, it's only $5 per point. So a 100-point move against you is $500. You know, how often does the Dow really move 100 points that you're not going to be able to do something about it? So that's your risk. And if you can't afford to risk $500, if you can't lose $500 in 10 seconds, don't play the futures. It's a very high-stakes game, but you shouldn't be playing TZA either if you can't afford to lose $500 in 10 seconds. So, you know, so the point is, if you're going to make these kind of trades, the futures are so low friction, they're so cheap to trade, they give you exactly the move that you asked for. You know, it's really something you should put in your toolbox, and something that you got. It's just a matter of practice. All right. In fact, if you guys remind me, we should do a futures trading webinar again. We're going to do one obviously in Vegas, but on this thing, let's do another futures trading webinar, maybe like next week or the week after. Just to really go over this stuff, because I mean everybody should be able to do this. Make $500 a month. It took me like 30 seconds to make $500 or 2 minutes maybe. All right, and you see how we're at 1, 2, 3 now. So here, if I'm bored, I just go like that. Ow, well, that wasn't nice. You canceled my order. Anyway, so now I put my stop up here, and I expect it to get filled now, because I put it close, and if you put it close, they're going to take your stop if they're going to do something. There they go. But, okay, I'm done. Boom, $500 exactly. And for me, that makes me happy when I can make, you know, for me, that's like a number I like. I like $500. I like $1,000. It's like when I make that, I can like, I'm done. It's a dinner. I can take everyone out to sushi tonight, and it costs me nothing. It's like free dinner tonight. So, so you know, that's what I play the futures for. It's just for fun. But if it's not fun, I don't know if I'd recommend it. I mean, it should be fun money. It should be like craps rolls that you're playing. All right, rig puts, SCO puts, all good. Yeah, I think, look, if we're not at the bottom for oil, we're probably near enough the bottom where you can start looking at these E&P companies and the oil companies. But again, I am concerned because we could get a major collapse, especially in China. The Japan numbers were horrible today. You know, the Japanese manufacturing, the consumer spending, terrible. That's the world's third largest economy. And they're next to Japan, which is, and of course, if Japan's doing badly, China sells stuff to Japan just like they sell stuff to us. All right, so China's probably not doing well. So we have to be very concerned about that. Where do you get the lines on the charts? Those lines are the standard Thinkorswim pivot points. If you look at studies and you say add a study, it is a trend study. And you go to P, and you see down there it says pivot points. And that's all it is. It's a pivot point study. Just add it to the chart. Anyway, so where were see, my instincts were good. So now it's below 1, and now it's below 1,102. Also, though, since my instincts were good, this is a shit finish. This is not what you want to see coming into the end of quarter. There's some serious weakness. And, oh, that's the last thing we should go over, because yesterday, Open my chat thing. There it is. All right, so yesterday, I think it was yesterday. Okay. So yesterday we had these SQQQ. I was worried that we weren't being bearish enough in the income portfolio. Now, the reason I said that is because a few people said to me that they're playing the income portfolio but not the short-term portfolio. That kind of scared me because I thought everybody would play the short-term portfolio too. With the income portfolio, the idea is to offset long-term trades. And if you're not, so I said if you're not playing the short-term portfolio, then you have to have a hedge in the income portfolio. And so I said, let's try this SQQ. So now we just, for an example, I'm putting the SQQQ in the income portfolio. We spent $5,000 or $4,500, whatever it works out to, in the SQQQ January 30-40 bull call spread. And in the short-term portfolio, we wanted SQQ anyway, so we put double that into the short-term portfolio with 40 contracts. It's a new addition. And again, SQQQ is at, and what are we doing? We're shorting the laggard. In other words, the one that hasn't gone down yet is a laggard. If you're betting up, you want to short the laggard, the one that hasn't gone up yet. But SQQQ, or the NASDAQ in general, has not fallen, so SQQQ is still hugging the bottom here of this channel. Pretty firm bottom, though, so far. And look at that 50-day moving average. So it's going to do, it's doing what they call a triangle squeeze, it's doing what I call a triangle squeezy thing. So it's going to come up here, it's going to jigger-jagger in here, and it's either going to break up or break down. Now, what do you think is more likely to happen? Is the NASDAQ going to have a massive breakout, or is the NASDAQ going to have a massive breakdown? And if the NASDAQ has a massive breakdown, then this will have a massive breakout, and we'll get up to like that 47 line. So that's the basis of why we're making that spread. All right, so yes, that's the most important thing I had to tell you. Make sure you have that coverage. This is a terrible finish to the end of quarter, and we don't want to really see what happens tomorrow without having a good hedge on our hands, right? Okay, we're going to wrap it up now. Thanks for coming, everybody. Have yourselves a lovely, lovely week, and we'll see you back inside at Phil Stock World, okay? We'll continue the madness. All right, have a good day, everybody. Take care.